It's Andrew Bosomworth from Pimco. Andrew, thanks very much. Look, one of the big topics that people have been talking about lately is this target 2 money, this base money that's been sloshing around as a result of the ECB's 3-year loans. A lot of it seems to be coming to Germany. We're seeing a deficit of this base money in some of the peripheral countries. Is this just accounting, or is it really a risk?
It's both, David. So long as the Eurozone sticks together, it's just an accounting entity. But that's a big if.
Well, you say it's a big if. Do you think the Eurozone is going to stick together? I mean, Christine Lagarde is looking at Greece, saying there's a possibility that they could have a big stumble there.
I think that's a real risk. I think one thing is clear: the status quo, the Eurozone as it is right now, is not a going concern. It's broken. It needs to be fixed. As a consequence of that, we can't rule it out that a member state chooses to exit, but that's a decision that only the people in that country can take. And if it were to happen, and if it were a country that has a deficit position vis-a-vis the target 2, then those target 2 balances are at risk.
And so basically what you're saying is that Germany is going to be on the hook for whatever the balance difference is with that country that leaves the euro?
Not the full amount, because those target 2 balances are shared pro rata across all of the member states. So Germany would be on the hook for 27%. Actually, Germany is offloading its risk to France, to Italy, to all the other countries who would have to share in that. And at the end of the day, even if there were a default by a central bank on its target 2 obligations, central banks can work on negative equity. It's not going to be the end of the world. It's obviously not ideal, but life will go on. Okay,
well, that's interesting to know. But what about the inflation aspects of this money that's sloshing around in the system as well? I mean, is there a possibility that we're going to see more inflation in, say, Germany?
Yes, I think we are going to see that. That's going to be a consequence of this one-size-fits-all monetary policy. The financial stance in Germany is too loose for the demand in Germany. We're seeing it already. Asset price inflation in Germany is taking off, 4.7% at a national level in real estate last year. Some of the quarters in Munich are experiencing even 18% year-on-year price gains of real estate. This hasn't happened for decades.
Well, that must be taking the Germans by surprise. Let me ask you just about Portugal, your view on Portugal. Do you think Portugal's likely to go back for more money, more EU aid?
I think that will happen, yes, and I'm also convinced that the European authorities will provide that aid, because unlike Greece, the Portuguese administration and the people are fully behind the reforms. They are implementing them. I think we're going to observe slippage on those programs. They will therefore require more money, but the signals are there that money is going to come.
But what about restructuring? A lot of people are talking about almost the inevitability of a restructuring in Portugal.
That's a big risk, and in particular in the private sector, because the big challenge Portugal faces is to generate the nominal economic growth it needs to service the debt. There's the backstop of EU money coming in for the public sector, but there's no backstop for the private sector. So it's very likely we see defaults in the private sector.
Right. Tell me, just in terms of your asset allocation at the moment, where are you investing in Europe?
We're looking to what we call safe spread, pockets of safe spread, and those tend to be outside of the government areas. The periphery, we're cautious on the peripheral government bond markets because of the inherent risks in there, and we don't see value in the core markets neither. At 0% real yields for 10 years of duration risk is not a great deal. So we're looking for sectors like the corporate bond market, asset-backed securities, and emerging markets, to the extent there are some of them in Europe.
And just on that one question, UBS is calling the beginning of a bear bond market after that drop in US Treasuries we saw in the last week or so. What's your view on that?
I think it's a bit too early for that. The markets are obviously going through a bit of a scare moment here as some of the data get better. But if the fiscal authorities deliver on reducing their budget deficits, we're going to have 7 lean years ahead of us of growth, and I think also then nominal bond yields.
Andrew Bosomworth, thank you very much indeed. 7 lean years of growth ahead. Doesn't sound too good, does it? Back to you in the studio.